at the right time.
Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Shah and you're watching Indian Open. Let's go straight to the headlines. Theresa May is dealing with the mutiny within her cabinet as Foreign Secretary Boris Johnson also resigns. The Income Tax Department sells a part of Kane Energy's stake in Vedanta to recover some of the claimed dues. The rupee weakness may not be enough to help TCS make up for a small drop in margins when it comes out with its first quarter numbers today. No such worries for IndusInd Bank, which is expected to report a steady set of numbers today. And France take on Belgium in the first FIFA World Cup semi-finals later today. Boy, I tell you, all eyes out for that. But let's take a look at the trade setup for the morning. Seems like we'll have a good start and we'll get to that in a bit. But the start for the week as well was pretty healthy. It was a day of long build-ups that we saw in trade yesterday. Both the Nifty and the Nifty Bank added fresh OI gains. The level of resistance, more importantly, shifted from 10,800 to 11,000 levels. Remember, yesterday we were talking about how the range seemed fairly narrow at the start of the trading day, which is 10,600 to 10,800. Now we've seen that shift to about 11,000 as per the call levels that we saw in trade yesterday. But more important than this range is the momentum that we saw in broader markets. And for the sentiment to continue to remain positive, the broader market performance has to stay stable and continue. The small caps went up about 1.6%, the mid cap index went up about 1.8%. Those indices need to perform and need to stay in the green for the sentiment to remain positive. The breadth was heartening, as I said, but it was on a low volume day. Let's see if volumes tend to pick up in the session today. Yesterday, the cash market volumes were sub 24,000 crores on the NSE. Even the FNO volumes were sub 5 lakh crores. Let's see if the market breadth remains positive and the volumes pick up in the session today or no. What are the global markets indicating? Well, some bit of green on the screen for sure. The Nikkei is starting off with about 1% of green. Shanghai about 0.5%. The SGX Nifty is indicating some green as well. So some positive reactions that the global screens are showing. Let's wait and watch if that percolates into a start which is marginally in the green. We'll of course watch out for the two key numbers in the session today, which is IndusInd Bank and TCS. TCS naturally will come out post-market hours, but that and HCL Tech should keep the IT space excited today. And IndusInd Bank, of course, somewhere around noon or slightly post-noon, the numbers will come out around lunchtime, and that will be important from a private banking perspective. Remember, yesterday private banks, Yes Bank, Axis Bank, all of them contributed. It'll be important to see if we can see that momentum continue because of the numbers of IndusInd Bank. Stocks to watch today then. I think HCL Tech would be interesting. Remember when the first inklings of the TCS buyback came about, we were talking about how companies like HCL Tech, Infosys and the others will be in focus, because if TCS is announcing this because of peer pressure or otherwise, some of the other IT companies will go out and announce their buyback plans. We don't know the details as yet. There are some notes that are out and we'll talk about them a bit later on in the show. But let's see if that has an impact on HCL Technologies in the session today. It was up about a couple of percentage points in trade yesterday itself, but it'll be interesting to see if there is some further impact on HCL Technologies in the session today, so do watch out for that. Dish TV. The Q1 results came out, beat estimates. I just read Saloni's mail in the morning as well, and she'll come in and join in and talk extensively about how the quarter was and what the management commentary was. So that is something to watch out for. Dish TV, I won't dwell too much on it. We'll talk about it a bit later on in the show, but suffice to say, the numbers were reasonably okay. Let's see if the stock reacts positively on a day which is starting off in the green. GSFC, they expect about 693 crores of subsidy from the fertilizer department. The stock was up about a couple of percentage points yesterday on volumes which are fairly heartening compared to what the 10-day average volumes usually are for GSFC. Let's see if there is some more in store in the session today. And last but not the least, there could have been multiple stocks, but I wanted to do a bit of a throwback to a company that did well in trade yesterday, and that is Hexaware. It went up on substantial build-up on the FNO side. There were takeover rumors that came about in Hexaware, at least in the market circles, if not actually, and it added about 15% OI in the last 30 minutes itself. The total OI addition of about 90%, but almost 15% of that OI addition happened in the last 30 to 45 minutes of trade. So fair bit of flare up in the last half an hour for Hexaware. Let's see if there is continuation thereof. Remember, people are linking and we don't want to dwell too much on the rumors, but people are linking a bit corporate activity in Hexaware to the IT numbers that will be coming out over the next few days, particularly today. Let's wait and watch. A lot of times we have heard such rumors, so it may well turn out to be false. But this is the reason, primary reason why Hexaware went up about 19 or 13 or 14 odd percent post-close, and actually about 21 odd percent in trade yesterday. Let's wait and watch if there's a further flare up in Hexaware in the session today. So those are 3 or 4 stocks that I thought were important. There are many more, and we'll talk about them during the course of the day. But these 3 or 4 could well have some reactions on open. However, let's tell you what's lined up on First Word today is the collection of the top editorial stories that we believe we should bring to you. First up on First Word, Theresa May's soft Brexit plan is a threat as her own ministers go against it. Bloomberg's Kathleen Hayes talks about the implications. Earnings then take center stage. Consumer, commodity and technology companies may offset the weakness in PSU financials and pharma in the first quarter. Darshan has put together the expectations. Retail focus may continue to keep IndusInd Bank buffered from bad loan troubles. Shraddha tells us why another strong quarter is on the cards. And no fireworks expected from TCS yet again. Agam takes a closer look at the pulls and pressures on the technology giant. About the global news first, UK Prime Minister Theresa May may be battling to stave off a full-blown crisis after 3 ministers quit to protest her Brexit plan. Foreign Secretary Boris Johnson, the face of the campaign to leave European Union, quit less than 24 hours after the Brexit Secretary and his deputy put in the papers as well. Bloomberg's Kathleen Hayes reports on the possible fallout.
I think it's interesting. 24 hours ago, the view was, oh boy, Theresa May, she's doomed for a no confidence vote. Can she even survive the year? But now it seems like people are getting a little more sanguine. But let's remind everybody what happened here. Last week on Friday, she got the deal with her divided cabinet for a soft Brexit plan, maintaining ties to the EU. Last night or this morning in Asia, what did we hear? That in fact, David Davis, the Brexit secretary, was stepping down. And then on Monday, Boris Johnson, who was the foreign minister, former mayor of London, said he's stepping down too. Two of her 2 most senior ministers. So it's interesting. Today was supposed to be the victory lap in the parliament, presenting the plan and basically saying, I've done it. And in fact, it turned into more of a defense of a plan amidst a lot of pushback in Parliament. Let's listen.
It is a proposal that will take back control of our borders, our money and our laws. But do so in a way that protects jobs, allows us to strike new trade deals through an independent trade policy, and keeps our people safe and our union together.
And we have not even shown you some of the most raucous reactions. Let's look at the plan she has presented, the key points, so you'll understand why the hard Brexiteers don't like it. Britain stays in the EU's customs union, this creating a free trade area between the UK and the EU that avoids the hard border issue with Ireland. This has been one of the biggest sticking points, preventing the UK from even presenting something to the EU they might approve. British producers will follow EU rules on goods. Again, the hard Brexiteers don't like this. The UK will have different arrangements, quote unquote, for services. But bottom line, it means banks will lose their EU passporting rights. This is certainly a big issue for British bankers. Now, meanwhile, when you look at the reaction, Boris Johnson, of course, first of all, he put out his resignation issue early ahead of Theresa May saying anything about it. He says in a statement on Monday, the Brexit dream is dying, suffocated by needless self-doubt. David Davis, that former Brexit minister, saying May's plan, quote, hands large swaths of our economy to Europe, agreeing with Boris Johnson that she's giving away too much. Even so, she does seem safe for now. Pro-Brexit lawmakers don't have anywhere near enough votes to call for the no confidence vote. They also realize that this is not the hard Brexit plan is something that most households and businesses don't really want to see. Meanwhile, she is even attempting to woo support from the opposition, from the Labour Party. Many conservatives are enraged about this, but what's a beleaguered prime minister to do? But she has big challenges ahead. She's got to present her Brexit white paper this week, and then beyond that, she's got to meet with the EU. And many people have said they do not want to be too soft with the UK because they do not want other countries to think they can easily pull a Brexit again. So she's got a tough road to hoe, even if she doesn't get a no confidence vote anytime soon.
Well, that's as far as the global news go and the big one out there. Let's focus back on the domestics. Earnings season kicks off with two heavyweights today, IndusInd Bank and TCS. Both nifty companies will come out with the quarterly numbers, and most analysts are hoping that some of the momentum witnessed in the first 3 months of 2018 will continue in the new financial year. Right, Darshan? I'm talking about the whole market at large.
Yeah, so basically that's the momentum they believe will continue. They've given their estimates for Nifty also, which pretty much is a common thread across, because most of them have their own set of stocks that they cover. So for the Nifty, on an average 20 to 22%. But let's first take a recap of what happened over the last four quarters. So what we've seen is that fourth quarter was a decent quarter. If you're seeing the number of strong results, they've come up significantly from as low as 12. It's moved up, and the number of inline has reduced from 25 to 19. The weak number pretty much stays in the levels of 13 to 14. But compared to what happened over the past few quarters, over the first 3 quarters, fourth quarter at least was a decent quarter, and a similar trend will continue because certain cases were similar, because they also come out of the GST impact, they also come out of the demonetization impact. So that's what we are watching out as far as the numbers were concerned. Now, if you're pulling up what the earnings estimate for the Nifty is, so Nifty or the Sensex is basically this is what the brokerages that have come out with. So Kotak is the most conservative. They don't see much growth coming in, only a 12% growth on the Nifty or on the benchmark indices. Antique sees a 17%, but rest of it, Deutsche Bank, JP Morgan, Edelweiss, ICICI Direct, see an EPS growth of anywhere between 20 to 22% that will come in. So these are the estimates. We'll need to watch out whether they meet the estimates at the end of the quarter. Basically, what will aid first quarter earnings? First of all, there is a low base due to the lead up on the GST and demonetization, and weaker rupee this time around will help a lot of export oriented sectors. So that's the broad trend that we are seeing. Now let's break it up into sectors, and that is where you'll come to know what is the main expectation. So basically for auto, the low base is something that will aid the numbers. You've seen the auto sales numbers come out every month. They've been strong. They emphasize on the fact of rural demand. Exports have been healthy, and that is something that will aid the auto industry this time around. The next sector that we want to talk about is basically IT. TCS will come out with numbers today. Weaker rupee will aid the top line this time around. Historically, if you see, the first and second quarter are the strongest for them, and there is no expectation of any major change in guidance. So it will be an inline to slightly strong set of numbers from the IT industry. The third set of industry is basically the FMCG, which did extremely well over the past few quarters. There is stabilization in trade channel post the GST implementation. There is consistent consumer demand that is coming in. Stable input prices is something that will aid the margins of the company. Volume growth is expected to be growth. So FMCG as a pack is something that you need to watch out for. The next sector we want to talk about is metals. Metals will be one of the strongest sectors. There is increased demand. The commodity prices is much higher. Volume growth is clearly there. Obviously, a little bit of concern could be the trade war, but that will be applicable in the quarters going ahead. And the dollar strength, that could be a little bit of concern. But overall, metals as a pack is expected to come out with a very strong set of earnings. The other set is basically the cement pack. Only nifty company in the cement is Ultratech, but overall, Ultratech did well last time, but the other cement companies didn't. But this time around, higher power and freight cost is something that could impact the margins. But demand has gone up. Some of them have taken price hikes, so it could be a mixed quarter for cement companies this time around. The other sectors that we want to talk about is the capital good in infra. Weak order inflow and execution is clearly there. Most of the capital good companies have not been doing well, and only exception on the infra side downside will be the road construction companies, because after HAM implementation, a lot of orders have come in. You've seen every day some of the other orders come in. So road companies probably may outperform this time around. The next sector we want to talk about is oil and gas. Higher crude prices will aid the upstream firms. As far as the oil marketing companies are concerned, because of the rupee appreciation that is there, that could impact them negatively going ahead. The other sectors that we want to talk about is basically the financials. Yeah, this is very, very important. Post most of the write-off that happened because of the RBI issuance in the last quarter, asset quality may improve for most of the banks, especially the PSU banks. What could hurt the PSU banks is the rising bond yield this time around. But retail-focused banks as well as NBFC will perform much better than the corporate-facing banks. That is something that is expected this time around. The other sectors, few sectors that are left, first of all, pharma. Pricing pressure in the US will continue. Domestic business will continue to drive earnings, and MNC Pharma, which has been doing extremely well and coming out with strong set of numbers, will outperform again this time around. And the last sector, probably media and entertainment. Higher advertising spends this time around. For the cinema companies, it will be a mixed trend. No major blockbusters that came out around. Telecom is one sector I don't think we've highlighted, and on telecom, pricing pressure will continue. Probably even losses may be incurred by the telecom companies. So that's about what we are seeing as far as earnings is concerned. 20 to 22% EPS growth, but as Jayesh had last time pointed out, most of them tend to revise it downwards. But this time around, it seems that the offtake from the fourth quarter was decent, probably will continue into the first quarter.
Well, let's wait and watch. Darshan, thanks for putting that into perspective. Remember, at the end of quarter four, almost everybody was saying that the earnings pickup will come in with a lag, will come in the second half. If we indeed see 20-22% in the first quarter itself, you could expect some bit of strength to return, because that's not something that a large portion of the market was working with, at least at the end of quarter four. So let's wait and watch. PSU financials may just spoil the party once again, but rupee depreciation might aid earnings. Remember, it may be bad for the economy, but it's always good for the Nifty 50 companies at least, if not more. However, a space that is likely to do well is private lenders, and first of the private lenders to report earnings is IndusInd Bank. It's unlikely to spring any surprises, but that's not unexpected, and that's not unwelcome, to be honest, as well. The bank is expected to maintain its strong growth trajectory. Shraddha Bawla is standing by with what the street is pricing in as far as IndusInd Bank goes. Morning, Shraddha.
Morning, Neeta. It's going to be a very boring set of numbers to track. Like you said, no surprises expected. Earnings growth trajectory to continue. Overall performance expected to be better than peers. So yes, that's IndusInd Bank and what we've seen from the private lender for the past many quarters. But in terms of the key estimates, net interest income is expected to grow by about 20.6%, led by strong loan growth and stable net interest margins. Net profit are expected to grow by about 23% to about 1,027 crores. That's the number the street is working with. Largely, net interest margins expected to remain unchanged, closer to that 4% levels. Remember, they had taken taken a hike as far as the MCLR rates are concerned, about 40 basis points or so in the fourth quarter. So steady margins expected. Even when it comes to some of the NCLT exposures and near nil restructured book, overall the corporate stress is relatively much lower as far as IndusInd Bank is concerned. So more or less the gross NP number should remain steady around that 1.2% level. As far as loan growth is concerned, it is expected to continue to come in between that 25 to 30% sort of a range, led by both the corporate and consumer segments. Within consumer also, it's commercial vehicle finance, credit cards and personal loans which are expected to drive growth. So what is important to watch out for then? The market share gains, continued momentum and market share gains in vehicle finance is a key factor to monitor. Traction in non-vehicle consumer lending portfolio is important. Also, margin outlook amid higher rates and increased competition in the retail segments, which the management had flagged off in the last quarter, also will be important to see. And finally, the progress on Bharat Financial merger, any sort of management comments coming in with respect to the expected synergies is going to be important to watch out for. But overall, good quarter, no surprises expected. Yes.
Well, and that's not too unwelcome, Shraddha, I would presume. Thanks a lot for that. Thanks for putting that into perspective. So that's IndusInd Bank, and that's the set of numbers, the nifty numbers that will come out during market hours. At some point of time in the show, we'll also show you how IndusInd Bank has reacted almost each of the single times that it has come out with numbers which are on expected lines. So that's something I will tell you a bit later on in the show. But for now, the last piece on First Word today, and that's by far the largest company in the country by market cap, TCS, which will report its earnings later on in the day. In fact, post-market hours, the technology giant is expected to post a muted quarter in the first quarter numbers that come out later today, with some contraction in margins. Agam Vakil is standing by with what the analysts are pricing in for TCS. Morning, Agam. Will the weaker rupee help TCS to offset the contraction in margins in any way whatsoever?
Absolutely. We certainly are expecting that to unfold in this quarter. But let me just start off with the headline numbers. And it's going to be a mixed quarter. It may not be a completely disappointing quarter, considering we're seeing so much growth when it comes to its top line. So let me start off with your dollar revenues. In dollar terms, we're likely to see an uptick of around 1.8%, about 5.8% growth in rupee terms. And well, while we can expect about 100 basis points contraction in margins at around 24.4%, we're likely to see a bit of subdued 0.5% growth in the bottom line sequentially. Now we're expecting the management to maintain their target of 26 to 28% in terms of margins. What is going to aid growth for TCS this time is going to be essentially the large deals that they've signed with Transamerica, M&G Prudential, along with Marks and Spencer. Do remember that a few quarters ago, the deals that they signed with something like Nielsen's and Scottish Widows are front-ended, and that is also something that will aid your top line going forward. When it comes to margins, as you've already mentioned, yes, the wage hikes will certainly bear down on margins, but we do have the cross-currency tailwinds that will partially counter that contraction. And well, we've seen a depreciation of over 5% of the rupee against the US dollar. So it's certainly one factor that will come in aid of not just TCS, but a lot of the other IT companies as well. What are we keeping an eye on this time for TCS? Firstly, well, deal sizes and digital services. This is something that we're going to keep an eye on for almost all the IT companies out there, but also tie-ups in the Internet of Things, analytics, as well as cloud services. We're also likely to see some more updates in the BFSI space, keeping in mind that Accenture has come out with another good set of earnings, not only reporting strength in North America, but also from the banking and financial space. And that'll be a crucial factor that I'll be watching out for. And finally, consistency in retail and manufacturing verticals, which have been relatively volatile over the previous few quarters. On the whole, we're expecting a mixed quarter for TCS, operationally weak perhaps, but certainly strong on the top line.
Yeah, Agam, one factor to monitor is also that even if it comes out with numbers which might be slightly disappointing, there are some technical tailwinds that help TCS stay afloat, right? I mean, the numbers marginally below estimates, unlikely to have a meaningful bearing on the downside for TCS, I presume.
But Neeraj, I would reckon that the earnings, if we do not see any big negative or positive surprises, I'm not sure how the stock will react. For now, at this point in time, what is really driving the stock is the buyback, the huge 16,000 crore buyback, and that is what a lot of investors are keeping an eye on. So let's wait and watch. For now, if we do not see, as I said, a very big negative or positive surprises, I'm not expecting a significant move on the stock going in.
Yeah, well, Agam, thanks for putting that into perspective. Those are the numbers for TCS, but frankly, even if the company shows a small miss, if at all, don't think the market will really be too perturbed about it because of the technical factor that we were talking about, the buyback that is on in place. Remember, IT could remain in focus today. HCL Tech has announced that they will mull a buyback on July 22nd, so July 12th, excuse me. So that is something that you need to watch out for as well. And Hexaware is, of course, in the midst of rumors. So enough and more IT companies in the fray. For news, Persistent and KPIT Tech incidentally hit fresh highs in trade yesterday. So the entire mid-cap IT pack as well as the large-cap IT pack is in focus. Let's wait and watch what happens going ahead. But I'm afraid that's all that we have on First Word for the day. A quick programming note, a bit later on in the show, Vivek, Chaand, Sehgal of Motherson, Sumi would be joining us to talk about the impact of the rising trade tensions on the company. And of course, we'll have an elaborate chat on the fund flows, the domestic fund flows, and the kind of tilt that they're showing over the last couple of months. But all of that a bit later on. After this break, a full tilt towards the day's trade. Stay tuned.
Sorry, I'm late. क्या हुआ?
कुछ नहीं यार. Just working on my expansion plan.
Funding का चक्कर.
It is so frustrating. I feel like banging my head against the wall.
No, don't bang your head. Cross the bridge instead.
Bridge?
हाँ, ये देख. ला.
अरे.
This bridge gets you in touch with interested investors. Funding happens, which means more outlets, more customers.
Interesting. And what exactly is this bridge?
A stock exchange created for your kind of company. Just list on it and help your business expand.
Really?
Yeah.
तो फिर लिस्ट कर लूं?
और क्या? शुभ काम में देर किस बात की? चल.
हाँ.
NSE Merge. साथ हमारा, सफलता आपकी. The SME Growth Platform from India's largest stock exchange.
This is a show which gets you a complete wrap of all the stocks that are buzzing in trade.
Everyone's a price taker, not a price maker out here.
There are better opportunities in the marketplace.
The return ratios will improve, margins will improve. What are you seeing? Valuations are extremely expensive.
It would take 100 years of profits to really pay off the entire debt.
Not all good businesses are good investments.
Good return on equity could be expected.
And I think that will sustain.
Their numbers, etc., were pretty sluggish.
How much longer they can sustain, I'm not too sure.
It has never been the scenario in any of the stocks.
It's an avoid for him at this point of time.
I wouldn't write it off in such a hurry.
We are getting into more complex chemistry.
Join me as I navigate the hottest stocks and help you pick the right stock at the right time.
Welcome back. You're watching Indian Open. Let's see how the Asian markets are faring at this point in time. Well, we are looking at marginal up moves for something like a Shanghai, but Nikkei and Hang Seng trading stronger. Nikkei, in fact, up as much as 1%. Where does the SGX Nifty stand at this point in time? We are looking at an uptick of around 0.2%, closing in on the 10,900 mark as we speak. And what kind of cues are we looking at when it comes to the derivative space? We have Navneet Saluja this morning joining us to give us an idea. Navneet, good morning.
Good morning, Agam. Well, we are definitely getting some positive cues if you look at the derivatives market. Yesterday, we closed above the mark of 10,850. So let's look at the Nifty futures first. The premium was just about the same, but the open interest went up, indicating that there were fresh long positions being taken on Nifty futures. But look at Bank Nifty futures. I think there was more traction on the Bank Nifty front, though the July futures continue to trade at a discount. But you did see the open interest going up by nearly 10%. That's telling you fresh long positions were taken on the futures front. What has been supporting this market is the low volatility. So if you look at India VIX, that's been below the mark of 12.5, which is very crucial for a lot of derivatives analysts. In terms of put call ratio yesterday, you had the Nifty PCR, which was just about the same, but it was the Bank Nifty PCR which surged quite significantly to 1.19. So watch out for that level of 27,000 probably on the upside for Bank Nifty. If you look at the option strike, actually, let me tell you what happened yesterday. There was put writing seen around the mark of 10,800 and the 10,700. Unwinding came in for the for 10,700 call and a bit of writing for 11,000. So the range in the near term remains between 11,000 now to almost 10,700. What did the institutions do? Well, positive cues actually coming in after a lot of days. If you look at the index futures, FIs added a lot of contracts on the long side. Whereas if you look at the index option side, there were positive or rather bullish bets seen. On the call long side, again 17,000 contracts, and you had on the put short, which is once again a positive position, that also added nearly over 6,000 contracts. So let's see what happens in today's trading session, whether we can conquer the 10,900 mark. That remains very crucial. In terms of stock futures, just want to highlight a few stocks. One of them is Hexaware. Very interestingly, the futures were trading at a discount, but the stock touched lifetime highs. It rose only in the last half an hour, so watch out for this one. And lastly, I just want to highlight Just Dial. Fresh longs were seen for this one, and you also had something like Max Financial. Short covering was seen for this counter. Back to you guys.
Almost missed from entering the band, didn't it, Just Dial?
Yes, it did. I checked the overall open interest. It was nearly 93%, so it missed by just 2%. So we'll be watching out for that data today.
Well, good news for somebody who was long on Just Dial yesterday. But let's see.
You can probably see a bit of more uptick coming in, but definitely there's a lot of build-up actually which was seen yesterday for Just Dial.
Okay, Navneet, thanks for putting that into perspective. Remember, we alerted this possibility yesterday that Just Dial was very close to entering to the ban, has missed it by a whisker, but if the action remains strong, you never know, could happen or could enter the ban in today's session. Okay, before we get in our fundamental guests on board, important to highlight one more set of numbers, and that is Dish TV. That space is in focus, and which is why we are reporting this separately. It reported a strong set of numbers in the first quarter. High subscriber addition aided the company's numbers. Saloni Dhanuka is here with more details. Saloni, what aided the numbers?
So Dish TV posted a very strong quarter. The numbers were well above the street expectations. Now remember, Videocon D2H merged with Dish TV earlier this March, and hence Q1 FY19 numbers cannot be compared on a year-on-year basis, and hence we are comparing these numbers sequentially. Now in terms of financials, revenues were up almost 8% at 1655 crores, while the net profit was down 77%, largely due to decline due to higher tax write-back in the base year, while EBITDA grew almost 40% to 557 crores, while the margins expanded by 7 percentage points to 33.6%. Well, in terms of subscription, Dish TV added 301,000 subscribers in this quarter went by, making the total base of 23.3 million subscribers. Now, the subscription revenue grew by almost 8% to 1,490 crores. Now, subscription addition was led by sports-heavy programs on the back of higher viewership due to IPL. Well, on the contrary, there was some softness in the viewership due to Ramzan in the last quarter, while average revenue per unit for Dish TV grew by 6.5% on a sequential basis to 214 rupees versus 201 rupees seen in the last quarter. Well, management attributes this increase in ARPU due to higher viewership in the HD segment, lower discounts, and the price hike taken by the management in the last quarter. Well, 44% of the subscribers added in this quarter were 17% came from the HD platform, making the total base of 17%. Well, in terms of merger synergies, as per Dish TV, initial merger synergies have played out really well for the company. Back-end infra, IT, as well as structural benefits have played really well for Dish TV. Management remains on track to achieve 510 crore of synergy benefits in the current fiscal year. And taking one brokerage view, IDFC has come up with a note on Dish TV after the numbers. They maintain their outperforming rating on the stock, and they believe that their Q1 numbers were well above the street expectations, and they believe Videocon D2H merger synergies will be a significant play for Dish in the coming year itself.
Thanks so much for that, Saloni. We'll keep an eye on Dish TV, which is likely to open in the green today. Some strength coming in, and of course, the numbers, well, they seem very, very strong this time around. The other company that will be in focus in today's day of trade is HCL Technologies. Can we take a look at how HCL Technologies has done over the previous few days? The reason why I say this is because we have seen tremendous strength in something like a TCS as well as Infosys over the previous 3 weeks. HCL Technologies has advanced, but not as much. What we understand is, according to a release from yesterday evening, well, it is going to take up and consider a buyback program this time, and that is day after, on the 12th of July. Now, as per your balance sheet details, well, it has net worth of around little over 36,000 crores, which means that by 10%, it can carry out a buyback of around 3,600 crores, and as per 25% could go up to as much as 9,000 crores. Well, we did a little more research, and we found out just the basic numbers. When it comes to your cash and cash equivalents, that stands at a little over 6,000 crores. And do remember, last time around, HCL Technologies did carry out a buyback around 3,500 crores. If you go by what TCS has done, they carried out a buyback worth 16,000 crores. It's the same as last year. So, well, TCS, or rather HCL Technologies, for this matter, is likely to give us a buyback of around 3,500 crores this time around as well. And that was carried out at a premium around 17% to the price on the day at which HCL Technologies was trading at. So, well, let's wait and watch whether or not we can also see if should the buyback come through, at what premium will the HCL Technologies carry.
But suffice to say, Agam, that there will be a bit of premium to this anyway. No company would go out and announce a buyback which won't get a premium.
Yes,
so
absolutely.
14-15% should be par for the course, I presume.
Which is why my estimates would be anywhere between 15% to as much as 20-25%, depending on what the buyback would be. And that is something that the analysts would also factor in.
Okay.
So we'll be watching after HCL Technologies. It is likely to move today as well, because it hasn't really given us the kind of gains that we seen in Infosys and TCS over the previous couple of weeks.
Well, interesting. Let's ask Mayuresh Joshi that. He's fund manager at Angel Broking, joins us right now on the show. Mayuresh, good morning and thanks so much for joining us on this wet day in Mumbai. We were talking about HCL Technologies, Mayuresh. IT is in focus. TCS numbers today. Hexaware, the dealing rooms were in the midst of a rumor frenzy about a takeover, and now HCL Tech buyback announcement post-market hours. What do you expect this one to do? A premium it will be? Will it be a substantial premium? Would you bet on it? And therefore, is HCL Technologies a buy at these levels?
Morning, Neeraj. So obviously, I think the announcements that they have done and what Agam was mentioning at this point of time, I think the foregone conclusion that there will be a premium to the buyback is a given. Now, what proportion, I think, is something that we will need to wait out for. But I think the premium should be quite reasonably higher than the current market price, which should entice existing shareholders to probably stick around with the stock. The second element in terms of what the management has probably reiterated in terms of its own business potential, I think a 9.5%, 11.5% constant currency growth is what they're aiming at. EBIT margins between 19.5%, 20.5%. And their key verticals, specifically their engineering R&D, which contributes almost 24% is expected to show signs of improvement, both in terms of earnings momentum as well as execution. In terms of their IMS segment, which contributes 35%, I think there again, I think the traction should be quite substantial. So what you're probably expecting in terms of core growth, I think should come through. But the only concern even within this growth parameters, Neeraj, is that it is growing inorganically. So I think the organic growth still remains extremely muted, which probably might take a couple of quarters to revive. On the valuation front, again, I think if I really assume an EPS of around 70, 72 odd rupees for FY20, I think it's still not expensive compared to its other peers. So large element in terms of growth coming back for one or two of its key verticals in the second half is something that the analysts on the street are looking forward for. Buyback and dividend payouts, I think an ideal way of probably returning cash back to the shareholders. And that should not only keep the markets enthused, but also the existing shareholders. So from the current standpoint, I think in the top tier names, HCL Tech obviously is something that I remain positive about, and a clear hold from my side along with TCS and Infosys.
Right, Mayuresh, I actually have a bunch of more questions on information technology, but before I do that, I'm going to go across to the research team and take stock of all the stocks which are going to be in focus in today's job trade, plus what's happening with some of the brokerages and what they're recommending. Good morning, guys. Thanks for joining us. Shudha, as usual, let's start off with stocks and news today.
Agam, a couple of names. I'm just going to run through them quickly. GSFC has said that they're expecting to get a subsidy of 693 crores from the fertilizer department. SRF will incur a capex of $60 million. That's about 400 crores on a BOPET manufacturing line in Thailand. Gayatri Projects and PNC Infra, both of these have been declared lowest bidders for two different packages of the Purvanchal Expressway project, were 2,700 crores and 2,500 crores respectively. Remember, these bids had been cancelled last month by Uttar Pradesh, so let's see how these stocks react. Sadhau Infra, the first quarter, or that is the April to June quarter, toll revenues have risen by 13.9% on a YOY basis. Aurobindo will be in focus as well, and that's on the back of ET report, which says that the company is in the final lap to buy Mallinckrodt's US specialty generics business, and they could pay as much as $900 million. The deal is expected to be sealed by the month end, so that's another stock to watch out for. UPL is next on the list. This is again on the back of a ET report, which says that Abu Dhabi Investment Authority will buy 20% stake in the Mauritius-based arm of UPL Limited for $1 billion. Also, you did see institutional institutional investors exchanged equity in Manappuram Finance in a bulk deal where Quinag Acquisition bought 3.1% stake and the seller was WF Asian Reconnaissance Fund. So you had Quinag increasing its stake and the seller actually lowering their stake. Both are existing investors. And finally, Magma FinCorp, they're going to meet Ramesh Damani Finance, Credit Suisse and other investors today. So that's another stock to keep an eye out for.
Right. A couple of interesting broking calls as well this morning. Jayesh, we have something on Oberoi Realty.
That's right, Agam. In fact, an interesting note coming in from Kotak where they have, in fact, upgraded the rating from a reduced to buy rating, and the target price has been revised upwards to 560 from 535. Now, they believe that while FY18, the cash flow was largely impacted on account of lower collection and, the acquisition of land that they did in Thane, they've made an advance payment for that. They expect FY19 to be more promising because of the Thane launch as well as cash that will start coming in from the 360 West project. What they also believe is that the pace of execution, that will be very important to watch out for, and the sales at Mulund will also, likely aid the sentiment of the investors. However, in FY19, the three key triggers that they're watching out for would be the new launch pipeline, improvement in the occupancy rate, as well as the project execution that will likely to drive the performance for Oberoi Realty. Agam.
And Ujjivan will also be in focus, Nikki.
Along with Equitas. In that case, HSBC has come out a note on both of these, and they've said that risk and reward ratio for both of these counters remain intact despite some encouraging signs, where they've said continued focus on a bank transition along with loan book diversification is continued to weigh on the earnings, and expect to improve the ROE to 15% from FY21. On back of this, they have upgraded Ujjivan to hold from reduce and hike the target price to 370 rupees per share from 329, and they say that FY19 is going to be an extremely crucial year for the counter for both asset diversification and liability base building perspective. For Equitas, they have maintained the buy rating. However, they have cut the target price to 150 from 159, which still implies a potential upside of roughly 12% for this counter. It says that the company is well positioned to accelerate its balance sheet growth from here on. In terms of risk that it sees for both of these counters will be rising rates, worse than expected asset quality, and inability to grow deposits.
Thanks, guys, for joining us and bringing us those details. But Mayuresh, I'm going to take the matter of the realty sector forward with you. How are you viewing the realty sector at this point in time, and are there any interesting ideas in the sector that you're tracking?
So, Arugam, again, I think a large element in terms of the accounting changes which are expected to take place and the expected probable hit in terms of how the companies will probably account for the same is one large element that one really needs to watch out for. But having said that, I think if you probably look at what has probably happened in the aftermath of demonetization and the implementation of RERA, I think a lot of these small unorganized players, as per our channel checks, are finding it a little bit difficult in terms of managing their finances, and at the same time you're probably looking at more compliances taking a toll in terms of their overall costs that they need to bear about. So I think the listed players probably in a sweet spot over the next few years. But again, I think within the pockets that you're probably looking about, the demand recovery also has to be quite substantial. So I think you're seeing some initial signs of pickup probably in areas out of North and NCR. The Western markets have held out pretty well in times like demonetization, implementation of RERA, but a large element of these markets holding up still remains our strong case for a few companies out of this area reporting strong numbers. Out of the South, again, I think a large element probably depends upon the IT sector as a whole. You're probably seeing some amounts of stability. I think the reported numbers that listed companies throw out, both in terms of utilization levels and attrition levels actually coming down, with a huge scope on digital investments by these companies, has given some stability to the sector. So again, selectively out of the West, I think stocks like Oberoi, Godrej Properties over a longer period of time can be expected to report reasonable and robust cash flows. And similarly out of the South, I think because of the inherent demand that you're probably seeing with selective launches coming through and large land banks that are available with revenue accrued, expected to pretty strong from recognized sales that they've done and sales velocity expected to improve. I think stocks like Brigade, Sobha also can stand up And the guidance given by Sobha, again, I think in terms of what they can probably achieve and the Q1 kind of estimates that they've meted out, I think it looks quite reasonable.
Mayuresh, what did you make of the Dish TV numbers?
No, so Neeraj, I think if you're probably looking at the numbers in terms of the post-merger scenario with Videocon, obviously comparisons cannot be drawn on a YOY basis, but the expectations in terms of synergy benefits of around 500 crores to come on the balance sheet is going to be quite substantial. The other element in terms of the reported numbers, both in terms of ARPUs and the kind of subscriber addition that Dish TV has done, again, I think a large element of that probably is expected to be there in the price. The third element obviously becomes what happens with Reliance Jio and the fiber band announcement that they've done, and the kind of implied impact that it can have on players like a Dish TV as well going forward. So though the pricing is largely unknown for the Jio broadband plans at this point of time, and what kind of mobile connectivity that they probably have to offer in terms of connecting TVs and your handheld devices, I think it's going to be very, very interesting on that aspect. And the fourth element obviously remains with the new tariff policy, which has recently got announced. I think, yes, there are some earnings positives that companies like a Dish, a Z, or even a Sun can probably derive. But a large element in terms of what the stock can do in terms of an earnings potential, obviously looking at the cost synergy benefits and any upgrades in terms of the earnings per share, I think it is probable and it is possible looking at the numbers. But I'll still look at other players within this space, but a sentimental uptick is not ruled out on Dish TV based on these numbers.
Okay, Mayuresh, stay on. So much more to talk about. Just getting a technical perspective in the show as well. Hadrien Mendonca, he's Senior Technical Analyst at IIFL, joins us right now on the show. Hadrien, good morning. Is attendance thin at your brokerage because of the rains? No, I don't think Hadrien can hear me. Hadrien, good morning.
Yeah, good morning, Neeraj. I didn't get your question. Sorry.
Okay, I think he can hear me. Hadrien, nevertheless.
Yeah, good morning, Neeraj. I didn't get your question.
Yeah, let the monkey chimes be. Yeah. Let's talk about the markets. The markets indicating some bit of an upstart in today's session as well. Yesterday was a good start to the trading week. How are you placing yourself for the rest of the week, Hadrien?
Yeah, so, something very good has happened over the last 1 week, and especially after the 28th June expiry that we saw, things have changed for the good, and in the past 7 days, we've almost seen a 300-point rally. So, that itself tells us that where the momentum is heading going forward. The only cause of concern here is that, after such a long and a strong upswing, we are actually observing a hanging man kind of a pattern. And I think these are early signs. I'm not saying that I've turned bearish, but these are early signs that we may see a little bit of profit booking. It's not only the hanging man, but also if you see the larger, daily chart, I think we are actually hitting this, the horizontal trend line resistance zone for the Nifty. So, going for 10,890 would be the first hurdle where the Nifty will find, a lot of resistance. Post that, there is also 10,930. So, I think these are two important resistance zones that I'm watching out for. Definitely, the tone is pretty bullish at the current, juncture, and any bullish trades should continue to be held and, play for another comfortable 70 to 80 points upside from here on. As far as the Bank Nifty is concerned, I think the Bank Nifty is also broken out from a larger symmetrical triangle pattern, which is another positive, because with the banks participating, I think we'll see a wholesome rally in the overall markets. Even if you notice in the past 2 days, we've seen a good momentum in the mid caps and small caps. They're making a strong comeback. So I think overall we're seeing good momentum everywhere. And I think for the banks, the next hurdle would be the 26,830 zone. A break above that would, make things a little more merrier for the markets.
And you have one of the banks as your top picks for the day as well, Hadrien. Can you take us through the calls for today?
Yeah, absolutely. Yes, Bank is one of the banks that have gained a lot of momentum in the past 2 weeks. In fact, it is on the verge of a very large breakout on the daily charts, and if you track the weekly charts, it is already broken out. I'm just waiting for a confirmation. So one can actually capitalize on this move. One can buy Yes Bank with a short-term trade for a target of 374 and keep a stop loss at 358. The second stock is a metal stock, and even I am surprised with this call because, and that's on a Vedanta. Vedanta has actually fallen for 4 straight days, and we have seen a doji pattern followed up with good buying, which we saw yesterday with good volumes. So I think one can have a small trade on Vedanta and play for a target of 232 and keep a stop loss at 223.
Hadrien, if I can just throw in one more chart check. About 8 or 9 days ago, a lot of people turned bullish on RBL Bank when it was about 550, 555. I believe you are one of those who recommended a buy then. It's now at 578, hitting new or nudging new 52-week highs. What should one do here? Is there a chance for a fresh trade?
Yeah, absolutely. If anybody is having a missed out feeling, one should not have that feeling, because this is just beginning of a new bull run for RBL Bank. In fact, we are seeing since inception, we've seen a long consolidation base, and it is on the verge of breaking out from there. So I think above 580, 585, one could definitely play the breakout. We have seen good volumes with good momentum on the upside. RBL Bank, I think, is all ready to move beyond the 600 mark, 620 mark in the near term.
Okay, on to our special segment then, Bloomberg Edge, where we have Jayesh Khilnani telling us about a pattern that the Bloomberg terminal has thrown up. Jayesh, good morning. What's on your radar today?
Morning, Agam. It's metals all the way. Yesterday we had the LME base metal index and that also reacted positively. Today we have Jindal Steel and Power that is given a positive crossover on the moving average convergence divergence indicator. Let's first have a look at the MACD and the theoretical conditions that you have to keep in mind while trading this indicator. It shows you the relationship between a 12-period moving average and a 26-period moving average as it plots the MACD line and the signal line as well. And you have to watch out for a crossing point which will help you to identify the turning points in a particular trend. How do you generate your buy and sell signals? Look for a crossover between the two lines, and the direction of the crossover will either give you a buy or a sell signal. Let's have a look at the chart of JSPL. Now you can see that in the last 6 months it has been on a constant declining trend, but near the 220 zone it tends to bounce back from these levels. Currently we are at about 221 as well, and you can see that this consolidation range, the consolidation has happened, and the bottom panel will show you the MACD indicator, which is, you can see the blue line has crossed above the white line, which gives it a confirmation of a buy signal.
Right, Jayesh, and on the back of probabilities based on history, what is the success rate?
So Agam works relatively well. The profit in the last 1 year would have been about 11 to 12% on all the trades that were taken.
Yeah, that's interesting. Jayesh, thanks for putting that into perspective. So stock-specific indicator yesterday, remember on Bloomberg Edge, we had spoken about the index looking like forming a bit of a bottom, and the index did rally a bit yesterday. Let's see if JSPL manages to do well in the session today. Mayuresh, fundamentally, is there merit in trying to own metals? The boom doesn't seem to have ended, the trade war fears notwithstanding. The correction, though, was fairly steep until now. What would you be doing here?
No, be very selective, Neeraj. So large element in terms of the implications of these trade tariff impositions is a large unknown at this point of time. And though I think the commodities, both on the ferrous and the non-ferrous sides, are reacting very, very sharply in terms of LME pricing. Again, I think the foregone conclusion here is that the inventories from China actually have slowed down. So I think if you probably look at data points from 2015, 16, 17, and even the current financial year, you're probably seeing the exports from China because of environment reasons actually getting slowed down. Having said that, I think companies within the Indian domestic scenario, and specifically steel companies, the demand outlook there still looks very, very robust. And a large element in terms of the inflation on the cost side is largely getting mitigated with push-throughs happening on the realization front. So I think the beta per ton is something that the companies will try to protect at this point of time. And a large element in terms of the expansion plans that a lot of these steel majors have probably divulged at this point, I think that should be something that should hold up because demand is catching up quite strongly. So in that sense, again, I think the domestic steel makers and players should probably hold out. What you've probably seen for players like a JSW Steel as well, even though they are probably expanding, I think the footprints that they've probably got in their overseas markets and the US markets is a sort of a shielding factor in terms of the trade wars escalating. What happens with Tata Steel in terms of their overseas operations and what we've probably heard so far with the Thyssen Group deal actually expected to go through. I think the overseas operations also probably are looking far better in terms of the overhang getting reduced. And the domestic operations, as I obviously said, is holding out. A contract call here, Neeraj, would obviously be Steel Authority of India because a large part of their capex is behind them. If steel demand, as our commodity team actually puts through, is expected to remain strong domestically, I think the earnings outlook, specifically in terms of the losses that they've been reporting on the bottom line, should start reversing over the next 2 to 3 quarters. And even their product mix, I think the product mix with larger margins should also have better earnings growth. So I think it can be a contra bet, but I think a large element, as I've also discussed earlier on our channels, is that if this trade war fears start getting into reality, I think none of these metals will be spared, whether it's ferrous or non-ferrous. So the ideal way is to probably look at declines and buy in a staggered way and be very, very selective within this space.
Okay. Mayuresh, stay on. Let's welcome in one more guest. Parthiv Shah, Director at TRACOM Stockbrokers, joins us right now on the show. We're talking about a bunch of stocks in news and the ones that will come out with numbers today, or they have come out with numbers today already. Dish TV was one amongst those. Parthiv, good morning. Let's also talk about stocks that will come out with numbers today. IndusInd Bank, you know, we were just looking at what the stock has done in each of the last 6 quarters that it has released numbers, save for Q3, wherein there was a bit of a miss and, you know, they had not released a couple of pieces of information. The stock has never reacted too widely on the number days. What do you expect the bank to do today and the stock thereby to do over the course of the session today or the next few days?
Good morning, Neeraj. Yes, Neeraj, in case of IndusInd Bank, I think we are expecting this bank to report stellar set of numbers. And this bank has been like a mirror image of something like what HDFC Bank has been doing in terms of not really missing out on the street estimates on most counts. And also in terms of things like credit cost and the way this bank is positioned. And also one of the key segments, which is the CV segment lending, which is doing extremely well for the bank. And overall, I think in terms of the return ratios that this bank reports, whether it is in terms of the asset qualities, the ROEs, the ROAs, and especially with the Bharat Financial merger, I think, which is definitely going to be value accretive to the bank. I think this bank is extremely well positioned. No doubt one will certainly argue that on the face of it, the valuations are stretched, are expensive, but that is the case with most of the well-run private sector banks, case in point being a bank like Yes Bank, Kotak Mahindra Bank, HDFC Bank, RBL Bank. So I think this is no different, and I believe that these valuations are never going to get cheap. If one waits for these valuations to contract, it's probably not going to happen the way the bank has been reporting the numbers and is positioned. So my sense is that, you know, maybe the stock might not violently react in terms of positive or negative during the numbers, because most of the positivities of the numbers are tend to get factored into the stock. But I think over the next 3 to 5 years, what we envisage is the balance sheet size of such well-positioned bank is certainly going to double in the next 4 to 5 years. And if that were to happen, the operating leverage that such banks get, I think the market cap valuation that will be created for the shareholders would be immense. And that is certainly looking like a possibility at an environment where the PSU banks are struggling. A lot of them are in the under the PC action. So most of that quality lending and the market share grabbing is going to be taken by these private sector banks. And the way the credit cost for IndusInd Bank is set up, I think this bank will do fantastically well going ahead.
Right. Mayuresh, you know, just earlier you did speak about TCS. You know, keeping in mind that the buyback is going to come through, we're going to start getting more details about the different timelines. What is it that you would look out for in the TCS earnings? One, the second is, what are your expectations here? Are we expecting any fireworks or perhaps subdued earnings? And 3, even if we do see a small miss in TCS earnings this time around, are we likely to see the stock remain possibly where it is in your experience because of the buyback? Keeping all these factors into consideration, how are you viewing TCS at this point in time?
So, Argam, I think 2 elements for the TCS stock, as you rightly put through. I think one, obviously, is the buyback element. And what they've probably announced, I think, should be supportive in terms of the stock price in general. Now, what they've probably done in terms of buyback would obviously improve the return ratios over the medium term. But again, I think then the entire focus shifts out to their core performance. Now, large element in terms of earnings expectations, I think the dollar revenue growth on a quarter-on-quarter basis should be quite reasonable, anywhere between 1.9 to 2.1 odd percent. You might see some amount of pressure happening through on the EBITDA margins and the EBIT margins on two factors. I think the cross-currency headwinds might have an impact, and the other element also probably becomes a part through in terms of the visa costs actually coming through. So I think EBIT margins around the 24.5% kind of a range is something that we're probably looking at. But again, a large element in terms of the commentary is something that will do the trick for TCS as it has time and again. So I think what you're probably expected to hear from the management specifically on the BFSI space is going to be very, very interesting, because this is one space that can actually drive the earnings fortunes for major companies like TCS or Infosys, because almost 32 to 35 odd percent of the revenue contribution comes through from BFSI. Now, insurance has been doing pretty well, so I think the BFS part is something where the entire emphasis of the management might be in terms of spending patterns actually expected to improve, and discretionary spending trends expected to drive the BFS vertical for TCS. So yes, I think one is the buyback, the second is the core fundamentals, and third obviously is the valuation. So I think valuations in no way are cheaper compared to the other listed peers. But I think if the earnings momentum continues, specifically in terms of execution and the digital investments that it has probably done, digital revenues will still account for a major chunk going forward. So I think the whole recommendation continues.
Okay, just hold that thought, guys. We're about a few seconds away from pre-opening, so we start getting those rates coming through. And as far as the Asian markets are concerned, mixed cues thrown by the Shanghai as well as the Nikkei indices. But the SGX Nifty is indicating an up move. And starting off with the Nifty and the Sensex, where we're going to have to wait for the rates to settle down. But the Sensex certainly is indicating some strength in the large caps. The Nifty, not as much, but in the green all the same. So let's pull up something like a TCS and IndusInd Bank to start off with and see how they are currently in pre-open. TCS showing an uptick of around, well, nearly 1%. IndusInd Bank, are we likely to see an up move there as well? Well, it's showing a 2% uptick there. HCL Technologies from the indices will also be in focus on account of the company looking at a buyback. 10% up move in pre-open rates. We'll wait for some of these rates to settle down. We also have something like an UPL, which is in focus because of some mergers and acquisitions coming through, an uptick of around 1%. And Aurobindo Pharma is the other one that is looking to buy a very important generic in the markets abroad. So that's, well, for now, marginally in the green for now. And finally, just one stock from the mid-cap space, and that is Dish TV. Do we have opening rates for that? With very strong earnings coming through, but for now, Dish TV is indicating an up move of less than 1%. Are we likely to see it more pronounced? Let's wait and watch. But these are just some of the stocks that I'm keeping an eye on. Just want to also pull out Asian Paints before I toss it over to Neeraj for some of the other big movers. Asian Paints was the top gainer on the Nifty yesterday, up 3%. Are we likely to see strength today? For now, it's indicating, well, marginal moves. What else are we tracking, Neeraj?
I want to see Hexaware, Agam, and just see whether it's picking up from where it left off yesterday. Well, I don't know if there will be another 9% move or no, but if there is another 9% move, then it just adds fuel to fire. This seems unnatural. It will change a bit, but if there is a substantial up move in today's session, then there is probably some method to the madness. Let's wait and watch. For now, about a 10% uptick. Let's wait and watch if that lasts or no. By the way, the currency is weakened a bit in the session today. Remember, yesterday we saw a very sharp pullback on the gaining side. In today's session, I think the rupee is weakened a bit, 68.77, actually just about 6 paise. So it didn't even last in trade yesterday, but further weakness coming in on the currency, 68.78. Just that now it doesn't seem too alarming as a pack currently. Okay, now what else? There is well, unnatural strength in HCL Tech. I don't know if there will be a 9% uptick or no. Let's wait and watch. Dilip Biltcoin had a 5% uptick yesterday. Seems like it will start off on a slight positive in today's session as well. The pre-open rates indicating a 5% up move. And GVK Power had a 5% uptick yesterday. Seems like it'll start off on a 5% uptick in today's session as well. So good going. Not seeing too many losers right now in the pre-open session. Let's give these rates a chance to stabilize, and then we'll talk more about them. Hadrien, I believe it's virtually impossible to trade a hexaware because it could be a news-based move. HCL Tech, though, again a news-based move, likely to start off higher. The question is, would you go out and build any kind of a trading position in an HCL Technologies?
Yeah, actually, we have to, actually see how the stock is going to react first, because if we're going to see a 5-6% up move, I think it wouldn't be a good idea to go ahead and, buy at, a higher rate of 5 to 6% higher. I think one should wait for a little bit of, consolidation or a sideways move before one can enter. But however, brave hearts, and there are a lot of aggressive traders that are there in the market, and I think if they want to play HCL Tech, definitely one can go ahead and build your positions in HCL Tech, because the breakout that has happened after yesterday's move is pretty strong with good volumes. I think the next hurdle on the upside I'm seeing around 1015, 1020 levels.
Okay, let's also bring in Sumit Sarkar to give us the brokerage calls for the day. Sumit, good morning. What's on your radar today?
Good morning, Agam. On the big brokerage calls for the day, first we have is Macquarie on Indian refiners. Now, according to the brokerage, the new IMO 2020 regulations will be a game changer for the Indian oil refiners. Now, according to this new regulation, ships can use fuels only with lower sulfur content, which in turn would boost the demand for middle distillates, which primarily include gas oil and jet fuel, according to the brokerage. Now, because of this rise in demand, the brokerage is also expecting the middle distillate cracks to expand to around $30 per barrel from current $15 per barrel by 2020. Now, Reliance Industries, HPCL, BPCL and Indian Oil Corporation are expected to benefit the most, as they can produce nearly 45 to 57% of these clean fuels. Now, for HPCL, the brokerage has maintained its outperform rating but has raised the target price to 570 from 500 rupees. Now, this is the highest target price by any brokerage on the street. For BPCL, it's an outperform rating, but the target price has been hiked to 555. For Indian Oil Corporation, again, it's an outperform rating, but the target price has been set at around 270, which is the highest target price. For Reliance Industries, they have raised the rating on the stock to outperform from underperform and has hiked the target price to 1,240 from 830. Now, for Reliance Industries, Credit Suisse also came out with a note where they have initiated coverage on the stock with an outperform rating and a target price of 1,180. Now, the brokerage is valuing Reliance Jio at close to around $10 billion in this, and as it is becoming more than just a telecom company for Reliance Industries, it is also expecting Jio's revenue to double and EBITDA to contribute nearly 10 to 40% of the total EBITDA of the company by FY25. Now, the company's new refining and petrochemical projects are expected to drive a 20% EPS growth for Reliance Industries in financial year 2019, according to Credit Suisse. Lastly, the brokerage says that the current softness in the gross refining margin may subside in the medium term, and the petcoke gasification plant of the company will add nearly $2.4 per barrel to the gross refining margin of Reliance Industries.
Interesting. We'll watch out for that. Thanks a lot for that, Sumit. Come in on this, Parthiv. A bunch of people saying that go out and buy Reliance, don't be deterred by the market cap. Large market caps have grown only larger, as is the case in the global scenario. And with what Reliance is doing in the media space or in the broadband space or the telco space, there is a re-rating in the offing. You second that?
See, I do, Neeraj, especially if one has a time outlook of another 5 years. Certainly believe that Reliance Industries is at an inflection point where a bulk of its capex, I think the capex that was done, which was started somewhere around 5-6 years ago, I think most of it is going to fructify over the next 1 year. And I think firstly talking about its cash cow division, which is the refining and the petchem business, and most importantly coming out of the AGM speech in terms of going ahead, I think most of the oil is going to get converted into value-add petchem products, which is very interesting because I think we know for the fact that as on date, both these two divisions are kind of separate, but I think the synergies after the capex in terms of the backward integration, things like ethylene off-gas cracker, petcoke gasification, all of that is going to help only this division to give fantastic set of numbers and fantastic cash flows. Now, if I were to talk about the retail and the telecom business, one always thought they are two separate companies. But this AGM did spell out the synergies that what a physical channel and a digital channel combined can have. So they are having huge plans to connect all small mom and pop shops with their network, and also the consumer business that they're targeting via the fiber to home connectivity and all the peripherals that they are willing to give and charge for that value-added service shareholders because they are one of the leaders in terms of the content. So I think if I were to look into any of the big telecom companies of US, Europe, they do tend to have huge market caps to the tune of $30 to $50 billion. Reliance currently, if at all I were to give it at a almost $97 billion market cap, all the three divisions have the potential to have Reliance a market cap of anywhere between $170 $180 billion over the next 5-7 years. Now, yes, one will always have apprehensions in terms of how they execute, but looking at their past track record, I think all these three companies, if they were to be segregated and given as separate shares to the shareholders, the value unlocking that we are envisaging, I think that can be substantially high. Being a large cap, yes, one might argue that doubling of a stock in 5-7 years is not a big deal, but looking at the market cap, I think that seems to be possible for Reliance.
Okay, the other stock, as I mentioned, Asian Paints, which had moved higher. Hadrien, it's currently at around 1,362 as per the pre-open rates. That's the settle down. Is it really hard to call a top on stocks which have moved into uncharted territories? It is hitting lifetime highs, and I'm assuming that at this point in time the buy on the stock would continue. But what levels would you keep an eye on Asian Paints, and how would you deal with something like this?
Yeah, in fact, Asian Paints is one of those stronger stocks that have broken out from a very, very strong flag pattern breakout, not only on the daily but also on the weekly charts. That gives us, that further accentuates our bullish stance on Asian Paints. So I think, the rise in volumes and other oscillators, both these parameters are actually in line with, positive bias. So I think it's very simple. Keep riding the momentum. The breakout is here, with good volumes. I think one should not exit Asian Paints unless and until we see any kind of distribution pattern forming. Right now, there are no signs. I think one should aggressively be long on an Asian Paints, and I think it is also on the verge of surpassing the 400, 420 levels in the near term. So definitely, it's a buy even at these levels for a short-term trade. If someone who's holding long positions, there is nothing to worry about. I think it's heading beyond 1400 levels.
Okay, we'll talk about HCL Tech charts as well. Now the pre-open rates have settled and it seems like starting off about 3.5% higher. But all of that in a moment, just minutes away from market open. Let's tell you all that you need to know to stay ahead in trade today. IndusInd Bank and TCS are set to kickstart Q1 earnings for the Nifty 50 companies. Both will report the numbers later today.
And HCL Technologies will consider a share buyback on July 12th. The company had last announced a buyback in March of 2017 for $535 million.
Dish TV reports a strong first quarter. Revenues more than double, while margins expand to 33.7%.
In key brokerage calls, Kotak upgrades Oberoi Realty, while HSBC upgrades Ujjivan. Credit Suisse initiates coverage on Reliance Industries with an outperform rating and a price target of 1,180.
Another stock to watch out for today would be GSFC. The company expects to get 693 crores of subsidy from the fertilizer department.
And Gayatri Projects and PNC Infratech have been declared the lowest bidders for the Purvanchal Expressway project. Remember, Gayatri Projects was declared the lowest bidder earlier too, but the bid was cancelled.
Well, that's all that you really need to know to stay ahead in trade today. Let's ask our fundamental experts, though, if they are willing to bet their money on any company from a 1 year, 2 year perspective. Mayuresh, just 3 minutes away from market open, so a slightly quicker view. At the mid-cap end of the market, which has been bruised more, are there some stocks, or is there one key stock that is looking very attractive at the current levels, current valuations?
I think JK Lakshmi Cement, Neeraj, is something that I'll probably lay my bets on. Yes, I think you have seen inflation probably shoot up, both in terms of diesel price impacting freight costs and coking costs also moving up significantly higher. But again, I think the capacity expansions that they've done, 13 MT on a consolidated basis, and what you're probably looking at in terms of cost optimization at its Dur plant, specifically with the conveyor belt and the waste heat recovery plant, that should abet its EBITDA margins and the EBITDA per ton. Also from a valuation perspective, at $82 per ton on an FY20 basis on a 13 MT capacity, I think it is poised for quite a strong earning growth, specifically out of the areas that it operates out of. So JK Lakshmi Cement on declines in a staggered way is something that I'll be looking at.
Interesting. Parthiv, same question to you. A mid-cap stock, just 2 minutes left. So a quick answer. We'll talk about this in detail later, but a mid-cap stock that looks attractive at the current valuations?
Sure, I believe a stock like KNR Construction looks extremely attractive after the correction. They have fantastic execution track record. I'm not really worried about all the rumor mongering that's going around in terms of financial closures of many of their projects. Their order book is extremely strong, and I think this company can deliver very well on execution, which will help the stock to further get re-rated. So I think looking at the current correction in the road segment, KNR Construction looks extremely good.
All right, well, that's your view on KNR Constructions. Can we also pull up UPL and see where that's currently trading and sitting at in terms of pre-open at around 627? Hadrien, can I take your view on UPL and how it's looking on the charts at this point in time?
Yeah, so UPL is actually consolidating. In fact, the good part over here is that it has stopped falling. You can count that as a positive move that is happening on an UPL, because the way the stock has been falling, it has been pretty harsh. So the current consolidation, we'll have to wait and see whether this turns out into an inverse flag pattern, or this really works out to be an overall base building step for UPL for further upswing to happen. So right now it is very difficult to say unless and until we see a breakout or a breakdown on either of the sides. So on the upside, I am actually looking out at a 632 level for a breakout, which would actually mean consolidation is actually happening for the good, or else on the downside I'm watching out for 618, because below that things can get a little more worrisome for UPL long holders.
All right, we just have about 40 seconds left, Hadrien. So quickly, just one stock and one stock pick for the day. First one is Titan. We've seen some volatility come through. Your call there, and what is your top call for today?
Yeah, so Titan is actually, placed at a very important 200-day moving average juncture. We may see a little bit of bounce back from here on in the coming days. As far as today's call is concerned, I will go with an IGL and also a Dr. Reddy. Both these stocks are looking pretty strong. I think one can play for a short term, 2 to 2.5% in the next coming day or two.
Yeah, IGL and Dr. Reddy's. Hadrien, thanks so much for joining in. Stay on if you can for one opening thought. Else, good to have you today. But this is how the markets have started. About 0.4% for the Nifty. The Nifty Bank about 0.25%. So 61 odd points in the green for the Nifty Bank. The Sensex 153 points. The mid caps and the small caps would have started off on a good note too, I reckon. Yep, about 0.4%. So nearly 0.5% or 1/3% kind of a move for the mid caps and the small caps as well. Let's pull up the heat map and try and show you what the bent of the market is looking like. Green, I presume, would be the order of the day. Hardly any losers. In fact, no losers. Bharti Infra marginally off, but all of these stocks very, very flat in the session today. So no key losers. What about the gainers? HCL Tech, no surprise, they're up about 2.5%. Tech Mahindra follows suit about 1%. Hindalco continues from where it left off yesterday. Remember, commodities did go up a bit in trade yesterday. Hindalco up about 1%. ONGC marginally higher. ICICI Bank had, well, a reasonable day yesterday, and Reliance continues to build strength. Yesterday was a key contributor. In today's session, up about 1% as well as Reliance Industries. But again, no heavy moves on the gaining side as well, save for maybe HCL Technologies, which on news of the buyback is up about a couple of percentage points. We'll try and take a technical view on this one, but that's probably the one stock which is making a serious move. Otherwise, it's a bit of a flattish start, but more green than red, which is actually a good sign. The Nifty, though, has cooled off a little bit from the highs of the day, just about 0.25% right now. The Nifty Bank absolutely flat currently. What about some specific stocks? Let me highlight 2 or 3 pockets, then hand it over to Agam for what's happening at the broader end of the spectrum. Stocks which were near 52-week highs in trade yesterday. Hexaware, well, fails to build up from where it left off, so very muted start. Similarly for Page Industries, 4% up move yesterday. In today's session, very, very flat. RBL Bank, though, continues to rise and shine, another 1.25%, good going there. What about Dish TV? Numbers looked fairly decent, but a muted reaction to the numbers, just about 1%. So no big reactions coming in from Dish TV as well. Well, maybe try and look at yesterday's movers, the likes of Dilip Buildcon, GVK Power. Both of these stocks had a 5% up move yesterday, and they start off well in today's session too. Agam, what are you spotting?
Well, Neeraj, before I talk about the broader markets, I just want to suggest you must keep an eye on the options movement in TCS, considering we are going into earnings, and TCS will announce its earnings post-market. So that's something we need to keep an eye on. That said, in terms of broader markets, well, we do have City Union Bank that's up and about. It's a lot of strength coming through in City Union Bank, up over 7% right now, along with something like a Reliance Naval that's also up 5%. Dilip Buildcon advancing in trade, up 3.7%, and well, Idea Cellular That's up and about Graphite India, as well as Star Cement. So we have some gains coming through when it comes to the broader markets. On the losing end, we have some weakness in Sheela Foam. That's down, if I'm not mistaken, by as much as 2%. There you have it at around 1,470. And HCL Technologies is now declining by as much as 2.5%. So perhaps some profit taking coming through at this point in time. Avanti Feeds down 1.3%. And we have some more weakness in JBF Industries. That's also down around 1%. Not too much to speak for on the whole, Neeraj. The momentum is largely with the gainers in today's day of trade when it comes to the broader markets.
It certainly is. Do we still have Hadrien Mendonca? Because if we do, okay, I think he's left. But nevertheless, I would have loved to take a chart check on HCL Technologies. That has started off well. Must say, Hexaware hasn't. Keep that at the back of your mind. After that big move in trade yesterday, Hexaware is starting off very, very muted. Okay, let me just try and take first a short-term reaction from our fundamental experts. Not really a trading reaction, but Parthiv, we haven't spoken to you about HCL. We did speak to Mayuresh about that. Let's ask you about a couple of percentage points higher. We quite don't know the buyback price as yet, but suffice to say, to yesterday's closing, there could be a premium, maybe 14%, 15%, maybe slightly higher. Would you buy into an HCL Technologies? Tactical buy.
Sure. See, I do believe that valuations are extremely comfortable for a company like HCL Technologies. No doubt, one would admit that last couple of quarters as compared to its peers like Infosys and TCS, they have slightly underperformed because the BFSI vertical, which has been doing well for the other peers, especially Infosys, HCL Technologies forms around 27% of their revenues in there, and most important vertical being the infrastructure management services, which I'm believing that based on the results and based on the outlook of the US-based company, should kickstart. And I think if I were to compare the buyback they did last time, it wasn't a substantially big buyback in terms of the quantum. It was, if I'm not wrong, around 2.5% of the reserves, and overall the price that they had set was almost at a 17% premium. So if I were to assume that even this buyback, if at all, they could be slightly higher because buybacks have become more tax efficient, and HCL Technologies has a fantastic cash kitty of almost around 11,000 crores, and the free cash flow that they generate as a percentage to the sales is one of the highest in the industry. So I think it would make very good sense to go in slightly aggressive because the valuation call is not very stretched. And even if I were to give HCL Technologies on a FY20 basis 15 times, then there is certainly an upside of around 20% from here. So we're not at all negative on HCL Technologies. We do believe that this company will catch up. All the inorganic acquisitions that they've done last year should fructify, and the synergies should be visible in FY19.
Okay, you know, I'm going to stick with the IT space because I was running a check on year-to-date returns for the NSE 500 companies, and among the top gainers, 6 of them are from the mid-cap IT space. It's not too much of a surprise because we do know of the substantial returns that the IT companies have given. That said, standing out in the NSE 500 in such a manner, well, it could surprise some, especially when the NSE 500 has actually declined by as much as nearly 2% on a year-to-date basis. Mayuresh, can I take this point forward with you? Anything that stands out in the mid-cap IT space for you, despite and after the kind of run that we've seen, the gains that we've seen for the mid-cap IT companies?
No, so the gains have been substantial, and as you're rightly pointing out, Argam, I think the outperformance has been clearly led by mid-cap IT, and the large-cap ITs have not been left behind as well. Having said that, I think within this entire universe, stocks like Mindtree, Cyient, of which we've liked in the past, have also probably grown at a very fast pace, both in terms of their earnings outlook as well as their management commentaries are extremely supportive in terms of the price moves that you've seen. As I mentioned earlier, I think for this quarter, I think there might be a blip in terms of elevated visa costs. And again, partial wage hikes probably causing a dent in terms of the margin profile. But the overall outlook, both in terms of the client wins that they're probably doing, the execution patterns that they're probably adhering to at this point of time, as well as the kind of expectations from digital investments that they've done. Digital contribution is almost 23 to 25% for the mid-cap universe at large, as well as for the large-cap IT players. So I think that's substantially going to aid earnings growth. At the same time, I think the other parameters with a strong order book probably helps in having utilization levels at higher levels and attrition levels going down. Again, I think the management commentary surrounding the constant currency and dollar growth is better because of the size at which they operate compared to the large cap players. But selectively, I think companies within this space still look very, very attractive. So I think Cyient, Nucleus Software is something that we'll still be looking out for in terms of earnings growth and earnings momentum.
Interesting. Well, bearing that bearing that strength is also stocks like Persistent, which actually disappointed in Q4 meaningfully, and yesterday nudged fresh 52-week highs, 849, 850 or thereabouts. Yeah, 861. This is new highs for Persistent Systems as well. So it just shows and just reiterates the point that Agam was trying to make. Mid-cap IT in a space of its own. What is sitting atop the pack of gainers on the Nifty 500 today, though, is Sterlite Tech. Third day in a row now, gains of over 5%. They made a small acquisition, remember. Announcement came in Friday, adds about 9% to EPS. But maybe, just maybe, the point also being that the stock was beaten down from 380, 390 odd levels all the way to 265. So a bit of a rebound out here for Sterlite Tech. Parthiv, the question though is, at these levels, it's not terribly expensive, but it's not cheap either. However, it's a company probably present in the right space of growth. Would you go out and invest fresh money into a Sterlite Tech? Why or why not?
See, Neeraj, frankly, I think as you very rightly mentioned, from its peak of around 380 levels, the stock got battered thanks to the mid-cap carnage. Nothing wrong in terms of the fundamentals. Rather, I was positively surprised when the management reiterated that they are fully booked with their expanded capacity for the next 2 years, which goes to show what sort of demand is going to be there for the optic fiber cable that they're deploying. And also, I think they have almost increased their capacities by almost 40%. And this is one rare company in the listed optic fiber cable space in India, which has full backward integration capabilities, which is kind of rare. And not only that, we are knowing that with the advent of 5G, I think a lot more fiber optic cable will be used. Say a player like Reliance, you're talking about fiber to home connectivity. A lot of fiber is going to consume within India. There are a lot of specialty projects that they're doing for, say, people like Department of Defense, along with the military, for specialized communication, secure communication network. So that's a part of their value-add business as well, which are long-term in nature in terms of contract. The capacities in China are ramping up extremely well. So yes, you're absolutely right. The valuations maybe are not extremely stretched, nor they are cheap. But based on the next 3 years' growth, we won't be surprised if at all this company would deliver anything less than 20% of EPS growth and PAT growth. And even with the operating leverage that they would have with the expanded capacities, we are expecting some sort of margin expansion as well. So when there is visibility, this is a type of market which is willing to pay a premium. And luckily, this stock had come down below the 300 levels, which was looking very attractive. And now we are seeing a lot of value buying. They're very good at inorganic acquisitions. The acquisition is value accretive. So overall, yes, even here I feel if one has a 3 to 5 year view, this is a company which probably I feel won't disappoint.
All right, Parthiv, strength in something like Dr. Reddy's continues. How are you viewing the space, and what would you do with some of these pharma companies? Perhaps let me just keep my question to the large cap pharma companies. What's your view and what's your approach here?
See, my sense is that the highest level of pain that all these pharma companies, especially the ones focusing in the US markets, Dr. Reddy's of the world, Lupin, Sun Pharma of the world, even Cadila for that matter, I think they've probably seen the worst amount of pain, and probably market is already aware of what sort of pain they've seen, what sort of price correction erosion they've seen in their products, what sort of pipeline they have. So my sense is that most of the negative seems to be factored into these companies, and luckily of late we have seen some sort of rebound in these companies, purely based on the fact that come FY 19-20 onwards, I think we are going to see a transition from the generic drugs to the complex generic drugs and to the biosimilars and the complex pipeline, the specialty pipeline that we talk of. Many of these big companies have not let down in terms of their capex and their R&D spends for the specialty pipeline, which definitely is going to pan out. And even out of the 4 or 5 big drugs that they're working on, even if 1 or 2 fructify over the next 2 to 3 years, then we'll see a huge ramp up in terms of the sales volume and also the margin expansion, which is what probably the street is betting on. And these companies have a good past track record. Yes, in between, due to all the challenges they're facing, the stocks did derate massively, and also most of the compliance related issues, it's seeming very clear that these companies have been ahead of the curve of late in terms of hiring the best consultants and getting all of these past issues cleared. So with the Halor clearance, with Cadila having Moraya clearance, even Dr. Reddy's having some of its its EIRs in some of its plants is very good news. So I think there is a sense of visibility, and this is a sector which is underowned, and with the rupee depreciation, I think would make good sense to have a part of the portfolio having in this sector.
A set of stocks which are trading at fresh highs for themselves. Graphite India, HEG, RBL Bank. RBL Bank has been nothing short of a sensation. For a bank northwards of 20,000 crores of market cap to gain almost 8 or 9% in the last 9 days is something which some of the other banks haven't done. So this is doing very well. But Mayuresh, I want to draw your attention to Graphite India and HEG being included in the ASM had their bearing on these stocks, corrected quite viciously, I might add, for a few days, but now finding their bearing, and doesn't seem like the fundamentals are out of the way. The managements and at whichever forum they have spoken have only spoken about how the price strength remains and the volumes look like they will continue. What would your thought process or recommendation be on these companies? Are they good companies to invest in even after the bit of a pullback that they've had from the recent lows?
So I think it's very difficult, Neeraj, for the sense that I think the kind of expectations that one has, I think at least over the medium term, over the next 6 to 9 months, I think the scenario that you're probably building up actually looks very, very robust for these companies, because through the electric arc furnace route, the demand for graphite electrodes obviously is going to improve quite significantly and stay that way. So again, I think the news that we're probably hearing out, 150 million tons of curbs that the Chinese government has probably done in terms of the traditional way of producing steel, and whatever new capacities are expected to come through specifically in the arc furnace route of 66 million tons, I think the demand supply dynamics still favor companies like a Graphite and an HEG. Having said that, I think the kind of pricing that you're probably looking and the availability of needle coke, which is the key raw material, is going to be extremely critical going forward. So whatever inventory that they probably utilized in Q4 in terms of the low cost of needle coke is largely behind them. So what these companies have delivered, both in terms of top line, in terms of their EBITDA margins, I think that outperformance cannot get repeated going forward. Though I think the volume story and the utilization level across its plants are going to remain extremely high, creating the leverage. But again, I think the margins will probably come down. They've cleaned up their balance sheets. So if you look at a company like HEG, I think the working capital and long-term debt have all gone. So I think what you're probably looking at in terms of improvements specifically from a balance sheet dynamic perspective probably still stays on the cards. Now the utilization levels is something that one really presumes because of the availability of needle coke, and if one assumes anywhere between 80 to 90% I think the earnings profile probably still remains higher and on the stronger side. Valuations probably always have been expensive for these stocks with the run-up that we've seen, but the demand outlook probably looks extremely robust as the management has put forth and the data points that we are probably tracking at this point of time. So the up move can very well continue. Whether you invest, I think you probably need to look at valuation. So that's a very strong call to take.
Fair enough. And speaking of highs, Nifty is back above the mark of 10,900 for the first time in nearly 2 months. The last time the Nifty was trading above that mark on an intraday basis was the 15th of May of this year. But that said, I'm going to thank both our experts, Parthiv and Mayuresh, for joining us and giving us their views on the markets on this very, very rainy day. And we'll slip into a short break, but coming up next we have Vivek, Chaand, Sehgal of Motherson, Sumi, who will join us to speak about the impact of rising trade tensions on the company. And well, we will also have lots more lined up. So stay tuned into Bloomberg Quint and we'll keep bringing you more.
Sir, please believe me, I am in this business for the last 12 years. Okay, I'll wait for your call. Thank you so much.
They still don't know you after all these years?
क्या करें? पहचान ही नहीं है.
Simple solution है. List on the stock exchange. With listing comes recognition. Investors get interested in you. And funding happens.
Come on, yaar. I'm not big enough to list. Chal, let's leave.
There's a stock exchange exclusively for your kind of company. NSE Merge. It's the right platform for your business.
Really?
Yeah.
My kind of company?
Exactly. Get listed, get recognized. अरे भाई हीरे की असली परख जौहरी को ही तो होती है. चल.
NSE Merge. साथ हमारा, सफलता आपकी. The SME Growth platform from India's largest stock exchange.
Catching up on news feels like a test match. Want the highlights? We hear you.
It's an ocean of news out there. Need a navigator? We hear you.
Do you have analysis paralysis? A case of too much information and not enough time? Do you wish someone would just pick the most relevant topics and tell you what you need to know? We hear you.
Good morning. You're watching Bloomberg Quint. This is First Word.
Curated and presented by Bloomberg Quint's senior-most editors. Weekdays at 8 a.m.
Welcome back. You're watching Indian Open right here on Bloomberg Quint. Now remember, the talk over the last 2 or 3 days has been domestic flows, because while we've been used to seeing global flows moving out, equity flows, or equity fund flows, domestic flows ebbed in the month of June. Domestic investors chose to take a break. So is this just an aberration, or is the love for equities just coming off a bit? Let's put this question to two people who track this very, very closely. Kaustubh Belapurkar of Morningstar and Swaroop Mohanty, CEO of Mirae Asset Global Investments, both of them on the show with us. Gentlemen, both of you, good morning. Many thanks for joining in. Swaroop, let me start off this conversation with you. I know the obvious answer would be that it's too early to call this a trend because it's just been 2 months. But quite unlike 2017, the first 6 months of 2018 has seen 3 months, whereas where there has been a dip in equity flows and a substantial one compared to what we've seen in the other 3 months or almost all of the months of 2018. Is this a sign that investors do get a bit wary when the markets have turned a bit choppy, quite unlike the belief that people had in 2017 that this time around the domestic flows are for keeps?
Yeah, it's a fact that investors do get affected with the external environment. There's no doubt about that. But over the last 10 years, if you see it, the conviction just seems to be growing. Similar situation 5-7 years ago would have already seen negative flows into the market. But that's not happening yet. You know, you have to keep in mind that two sections of this flow are slowing down. One, rightfully, which is the arbitrage fund, which is still classified as equity, and that slowed down. And the other part is, you know, this huge aberration which had happened last year in the flow of balance funds through monthly dividends also slowing down. So these are two huge factors which you cannot sort of dissociate with flows at this moment. Apart from that, if you see, the markets are still positive to the amount of around 8,000 to 9,000 crores, with a robust flow of SIPs around 7,300 crores. So there's no stoppage on the SIPs, there's no stoppage on the core equity flows. It's just that two categories, according to me, which is the arbitrage funds and the balance funds, having slowed down.
Interesting. Kaustubh, I got a mail from your team yesterday about 1:32, wherein you were talking about flows and you spoke about how SIP flows have still stayed strong. I mean, what's been the data that has recently come out? And do you believe that in your interactions or your conversations, either with investors or with parties within this industry, that irrespective of what's happening to one-time investments, the SIP flows will stay constant?
Yes, Neeraj. So, you know, if you look at it, the SIP flows have only been increasing over the last 2 years. And like Swaroop was talking about, you know, this is the most sticky part of the flows. You know, these are monies that you typically put in month and month and kind of, you know, keep doing it for at least 3-5 years, if not longer. So these are flows that, you know, we would see to continue to grow. And that is the cleaner route for most investors to take, you know, that you're not really timing the market and, you know, coming in on a frequent basis. So this is going to be a large chunk and it'll keep propping up the flows. You know, lump sum flows have ebbed a bit, but I don't think that's a big concern. I mean, you know, like Swaroop was saying, there are a few categories that, you know, flows have slowed down. The other element has also been that We've had the recent recategorization of funds, so some of the investors will just be waiting for the dust to settle around. What are the new categories? What should I look at? And I would expect that flow should continue to remain strong, in the given 6 months also.
Interesting. So one is SIP flows, Kaustubh. The other is the kind of downtick that we've seen in balance funds. Now, what to your mind is the reason for that? Would this be the equity market softness, or could there be other reasons which are attributable to balance flows, like the taxation benefits that were existing until March and now no longer exist compared to ULIPs?
Sure. So, Swaroop did touch upon it that, there was an element of dividend that was being paid out through last year, which, attracted a lot of new investors to balance funds, which now, given that there's a dividend taxation, even on the dividend of 10%, it actually makes sense to go into a growth option to our mind, because you do have a, 1 lakh window where you pay no long-term capital gains tax every year. So that's where we're seeing the ebbing of flows on balance funds, and we expect that will kind of taper off, to these levels.
Swaroop, large, mid, small, whatever the size of the house, what do you expect the rest of the year to be like? Because I'm sure that even in these 2 months, wherein the flows have ebbed off a little bit, at least the one-time flows, if not the SIP flows, you guys would have gone out, spoken to investors, done road shows. AMFI as a body would have done all of this and would have gotten feedback about what is it that could be concerning investors, if at all. What has the feedback been over the last 2.5 months, not just what's happened in the last 10 days?
So if you look at the beginning of the year, some of it was anticipated because, the whole external environment of the election definitely has been playing on people's mind, and some amount of this ebbing of the flows would be credited to that. Having said that, last month we just launched a healthcare fund and we did quite well in the market, which speaks of the fact that investors are looking for good values everywhere and are looking for good stories for investments. I don't think there is a dearth for money coming into the equity funds. It's just that, some people who have invested are waiting for, as Kaustubh rightly pointed out, the recategorization story to completely play out in a nice manner. Advisors are waiting for the true picture to come out. So that it's just 2 months of that. And we do believe that with the mutual funds IEA campaign going around quite strong in the market, the conviction levels on equity as an asset class is beginning to grow. Please remember that, traditionally we are not equity investors as a country, and that story is just beginning to start. I hope in the next 4 or 5 years we'll see a stronger conviction growing. The fact that the SIP flows are increasing are testament to the fact that the conviction levels are beginning to grow. Yes, there is a gap between what it should be and what it is. I completely agree on that, but the story is beginning to fall into place. And as asset managers, we have to live up to giving the investors a good investment experience, and that's key to everything. If the investors come in and in this period hold their money steady in the market and end up getting a good investment experience, a lot can happen in the next 4 or 5 years.
No, and please bear in mind, gentlemen, that the whole idea of doing this discussion today is also to talk about how 2 months do not justify, or 2 months do not give a trend. The trend, if anything, is on the upside. It's only a couple of pauses that we've seen, and we only hope that these pauses don't really turn into a bit of a downtrend. Swaroop, the response to thematic funds does suggest that people are looking for newer options. The question mark only is that, again, in the conversations that you would have had with your set of investors during various roadshows for the new fund or otherwise, are investors, getting a bit anxious or complacent with the traditional options and are looking for newer options? And that might be a bit difficult, right, with the newer norms, which almost place all funds at par. You have these 16 categories in equities within which you have to launch the funds. So the option of giving a completely new thematic fund aside of a sectoral fund might be a bit difficult. Are investors now starting to ask for newer funds which may give higher returns compared to the 10-12% that the traditional plans which are being promised by almost all AMCs?
See, I don't completely agree to that. The bulk of the flows lie in the Yeah, I mean, I'll give you our own experience. Our bulk of the flows still happen in our large two flagship funds, which is the India Equity Fund, which incidentally crossed 8,000 crores today based on flows over the last 5-6 years. The mid cap fund, which is the emerging equity, emerging blue chip, which we've sort of curtailed flows through the SIP route over the last 2 years, has continued to grow on the SIP part. So bulk of the flows still remain in the core equity funds, that is the diversified category, both in the multi-cap as well as the mid-cap. The thematic funds are always allocation products, and there's a time when most of them catch fancy of the market. We believed it was a time for the healthcare to start its flow, and a lot of our counterparts in the market also feel so. But I don't think the flows of the market can be determined by flows into the thematic category or any kind of strategic allocation. The flows have to be structurally strong in your core funds for markets to fall into place. And that continues to be the trend. At Mirae Asset, we've not seen the change in trend. Yes, we did start a thematic fund. For that matter, a consumption fund, which has done so well over the last 7 years, has not attracted as much money as the core funds have got. So I do believe that's the times come for thematic funds, but on a sustained basis, the core funds, which is the diversified fund, both in the multi-cap or large cap and the mid-cap categories, are places which will continue to get flows.
Kaustubh, is that your assessment industry-wide? I mean, Swaroop obviously has seen that for Mirae. I presume that's the industry-wide experience as well. But any thoughts that you have on this, which are different from what Swaroop just mentioned?
Yeah, Neeraj, absolutely. So I think it's a very true trend that most of the money, if you look at it, goes into the core categories, and that's really where it should be going into. So if you look at your large caps, your multi caps, your small and mid caps, that's really where the bulk of the money goes. Thematic is largely, you want to play it only for a satellite portion of your portfolio. Your core should be, of these 4 or 5 core categories. So, and that's really been the trend over the last, couple of years. In fact, just want to point out that since demonetization was announced, that's really what swung the needle of equity investing in India. If you look at it, mutual fund equity AUM is up about 60 to 70% since demon. That's 20 months since that. So, it's really grown significantly, but we're still, it's only the tip of the iceberg in terms of the overall context. As a market, we're only about 5.5–6% of the overall equity AUM. Developed markets like the US would be in excess of 30%. So we have a long way to go, and I think it's only the start of the journey. So I would tell investors, continue to focus on the core categories. You can look at some thematic as a satellite play, but really continue to focus on the long term and your core categories.
Kaustubh, one is investors taking a break from investing, holding back on their one-time investments. The second is the redemptions that we could have seen. What is your sense? The last 2.5 months, at least post-March, where has there been redemption pressure, if any? And part 2 of my question to both of you before we wrap up this discussion would be, what would it take for the resumption of those one-time flows? SIPs are strong, I admit, but the one-time investments which have just dwindled a bit, what would it take to restart them? Would it be strong equity market performance, especially the mid-cap end, or would it be something else? Kaustubh, to you first, though.
Yeah. So, I think, so March was a very unique month, right? So in the end of March, we obviously had some flows out, which is a very typical end of the year cycle where people would tend to look at their portfolios, do a little bit of rejig. It could also potentially be linked to, you had up to 31st March to actually sell out and, not pay any capital gains. Obviously, that was not the right thing because anyways, you had a grandfathering option as of the 31st Jan value. But I think some investors did take that route because it's operationally easier. So that's what happened over the last few months. Again, what we've seen is that redemptions, have come across categories. So it's not one particular category, but again, net flows have still been strong, largely driven by SIPs, yes. But I don't think that that's too much of a worry. Like I said, one is, I would wait for the dust to settle around the recategorization so that both advisors and investors are aware as to where, what categories, what kind of funds, what a fund is, what the mandate is. So I think over the next couple of months, obviously there is that overhang of the election year coming up. So we could see slightly muted flows, but, I expect there's a little more of, even if a correction, we could see some investors, the smart investors coming back in to use the dips to deploy some additional money.
Okay, and Kaustubh, just one question. Maybe I missed your answer, but where has there been redemption pressure industry-wide?
So it's Neeraj has been broad-based. So I wouldn't say it's a particular category. I think across large, mid, sort of it's been happening. So I don't think it's one particular category that's really been seeing a bulk of the outflows. It's pretty mixed there.
Okay. Swaroop Mohanty, Kaustubh, Belapurkar, many thanks, gentlemen, for joining in today. Really appreciate your time and talking to us about what may have caused unease to a few people, but at least the CEO of an AMC and somebody who runs arguably one of the foremost mutual fund monitoring agencies believe that there is no sign to be worried. SIP flows still remain strong. It's a matter of time before the one-offs start coming back into the fray as well. No clear trends as far as redemption goes. There is no particular category which has been impacted. So that's the other thing that you got to keep in mind. Nothing to worry. It's business as usual. Let's see what the months of June and July bring up. And then let's talk to them again to try and figure out if their views are changing a bit. Okay, the market's looking fairly strong. Remember, the problem area for the market has been what US and China have done. They've gone ahead and imposed trade barriers on some products. And while it may not have a direct impact or a meaningful impact on equity markets by and large, fundamentally may not have had an impact on Indian companies. Specific companies like Motherson, Sumi, who supply to companies across the globe, may face some backlash. Joining us to talk about this impact, this very impact, is Vivek, Chaand, Sehgal, the chairman of Motherson Sumi, and joining in for this conversation is Darshan Mehta. Darshan, over to you.
Yeah, Neeraj, so our guest needs no introduction, Vivek, Chaand, Sehgal. First of all, good morning, Mr. Sehgal. Thanks for joining us. Can you give us a sense of the global environment with issues related to the trade war that's going on? You have significant exposure to the global market. What's your assessment?
Oh, well, I think, of course, there is a lot of tension and there is a lot of concern. But as far as our business goes, we have seen that eventually when you've got to buy a car, you've got to buy a car. It's not really a luxury or something. It's a necessity. So I am pretty sure that whatever, if any, of the disturbance that comes would only be very, very temporary if it comes. But I personally feel that it's business as usual. There is going to be some impacts here and there. But overall, within the next, say, within a month, 2 months, everything would be fine. And there's a lot of posturing at the moment. But I've yet to see it get translated into, taxes and things like that.
I agree with your point, Mr. Sehgal, that demand will be there, but the point is that money will move, cars will move into competition, people will buy other cars. Considering this, do you think that your FY20 target of $18 billion will be impacted due to trade wars, as preference for brands will obviously change because of tariffs?
On the contrary, I mean, I don't want to sound very this thing about it, happy about it, but what actually happens is that the more the confusion, the more the opportunity, really. So in times of pressure, in times of commotion, Motherson actually gets that much more opportunities. So we are that much more sure that 18 billion for sure is not an issue at all.
Do you have an issue with what's the current situation with Volkswagen? Significant amount of news flow. Since you deal with them directly, what's the sense that you're getting?
Well, I think it's only to be seen. I mean, those people have paid everything, yes. There are certain countries which want to talk about it more. So that is going on, but it's got no new how do you say, not that I've heard of anything new about any of the news and all that. It's just the old cases, so it'll continue.
Mr. Sehgal, the performance of your subsidiaries SMR and SMP was rather weak in the fourth quarter. What outlook can you share for us now?
I think basically the performance of both of them are very good according to our standards. We are following exactly what the customers are telling us. And you see, we don't supply anything into the open market or something. So tepid performance according to whom, I don't know. But as far as we are concerned, we are moving absolutely as against the budget of our targets. And we are very happy with their performances. There is a little bit of startup issues and things like that. But those particular things are taken in the game, and we have to sort of make sure that we don't miss out on any of the deliveries or anything of the sort, which we are not. So we have 3 new plants rollouts. These particular plants are very important for us because, as I told you, they add 1 billion euros to the top line. At that particular time, I do not know, but at that particular time, the fourth quarter, they were saying that, this performance has not come through. But if the customer is not making the cars, and we have to go through the setting up of the plant and everything, I didn't understand the logic. But anyway, that's the way the market is. We are okay with that. We don't have any issues.
Okay, the other part is the China joint ventures. It's recent, but can you share us some progress of what's happening there?
I think China is following its natural course. We took over PKC, and with that we got 2 new joint ventures over there. Both of them are very, very exciting for us because they open up tremendous amount of possibilities. You see, PKC is into wiring harness this thing, but Motherson is also very strong in the interiors and exteriors for trucks and things like that. So we had recently, all our collaborators had come in to see what we have in India. And just the mere fact that they saw the kind of excellence that Motherson does in so many components over here is very, very exciting for them, and they've all gone back very charged up. So I think in the coming years, you are going to see much more than just wiring harnesses on the Chinese vehicles than Motherson is only into wiring harness, but also making plastic parts into interiors, exteriors, you name it. We'll be doing almost a lot of things over there. So it's very exciting for us.
Okay, we spoke about the global business. Can you share some update on how the India business is panning out for you?
See, India is doing very well. Once again, I'll repeat myself. We are an OEM supplier, 100%. So in that particular sense, what happens is that as our customers are doing better and better, we are also doing better and better. We have the biggest growth engine for Motherson is increasing content per car. We are increasing the content per car. There are new things that are coming in, new opportunities, new cars are much more on the upper side of it. So in the sense, people are going up the value chain, and that opens up tremendous amount of opportunities for Motherson as a group. So we're very excited with what's happening in India as well.
Okay, so can you give us more indication of the capex that's been planned for the year and any new factories that you're looking to set up?
So as I said, that we are almost through as far as our major capexes are concerned. So there might be a maintenance capex as such, and a few top up of capexes would be there. But we don't anticipate any major capexes for this year and probably the next year, unless we get a major order for which we'll have to set up plants.
Okay, and my final question before we let you go, sir, is what's the order backlog currently, and what's your sense of the pricing power in the auto ink industry currently?
So I think, there are a lot of opportunities that are coming up. The pricing doesn't have any pressure at all. If there is anything on where we feel that the pricing is not good for us, we don't take it because we have to set up new plants and things like that. So we are very sure and very positive. We are getting a huge response from the customers as well. The kind of products that we are making are very, very important products for the car. They're the aesthetics, they're the interiors and the exteriors and all that. And we don't see any sort of pricing on pressure or things like that coming on to us. So we are very sure that the kind of orders that we have are already in the bag, and whatever new orders that we are taking it on our terms, really.
Okay, we'll leave it at that, Mr. Sehgal. Thank you so much for speaking to us on Bloomberg Quint, Neeraj. So that was the management of Motherson Sumi.
Interesting. Doesn't seem to be too much of an impact. That
he doesn't seem too much concerned with what it is. He's pretty optimistic on his business.
Yeah, well, that's how Chaand Sehgal has been, and maybe that's how the business and the stock has done what it has done. But I guess it's time up on this leg of Indian Open as well. The markets are doing very well, or 0.5% is reasonably well. So it's a good start to the trading week, I would say. Yesterday we had a good start. Today we're continuing from where we left off yesterday. So the going seems to be good. On that happy note, let's wrap it up on Indian Open. Up next is the FNO show. Thanks so much for watching.